Hello and welcome to our crypto podcast. Today we'll be discussing the recent action in the crypto markets. And on today's call, you have two other founders from DefiDive. As I was just counting earlier, I believe Joe has been through about 4 or 3 bear markets, depending on how you define a bear market. And I myself with the modest 2 bear markets under my belt. So hopefully we can share some useful insight, but be aware that none of this constitutes financial advice, and anything literally can and will happen in crypto markets. So to start off with, Bitcoin is down 55% from its all-time high and 35% year to date. Joe, why are crypto prices crashing?
Yeah, no, first up, it's great to be on talking about the things we love to talk, and what a dramatic week. In fact, I don't know if we back up, what a dramatic year, because actually it's not just the crypto market, but markets as a whole have gone down a lot this year. In particular, this week, everybody's talking about crypto, what's happened with Bitcoin's price, what's happened with Ethereum's price, and what's happened with all of the altcoins in between as well. Yeah, so what we're seeing and experiencing right now is just a general market decline. Nothing too different from what we've experienced in the past, but it doesn't, of course, mean that people aren't panicking. And of course, we are seeing between us a little bit of blood in the water, as they say. But yeah, I guess that's where it's great to have that conversation to assure people that, look, these times are to be expected. It's best to try to act rational in these times and not to panic.
Yeah, and this is not a crash isolated to crypto. So, for comparison, there is a stock ETF which goes under the ticker QQQ, and that is down 25% year to date. And Bitcoin itself is down 35% year to date. So, at the moment, Bitcoin is currently doing just a bit worse than tech stocks, and Amazon in particular is down 35% year to date as well, exactly the same as Bitcoin. So we really are seeing very strong correlation to wider financial markets, and particularly tech stocks. And I kind of think that reflects over the past 2 years, we've had a lot more financial institutions come into crypto, and I think a lot of them probably see crypto as just another tech stock, and they probably value it in the same way as a tech stock, and they see it as a risk-on asset. And so, as interest rates are going up, these institutions are selling all of their risky assets that trade at high price to earning multiples, and they just kind of lump Bitcoin and Ethereum within that. That's what I suspect is happening. Have you what do you think about that, Fury?
Yeah, no, I have to absolutely agree. I'm so glad you opened with a reference to the QQQ, because that refers to, if I'm correct, S&P 500.
It is similar to the S&P 500, but it's actually a collection of tech stocks. I don't
Yeah,
remember every stock in it, but it works just like the S&P 500. But instead of every stock, the S&P 500 will have like Walmart and Tupperware, for example, in it, whereas QQQ is just tech stocks, and that's down 25% year to date, which is in the same ballpark as Bitcoin.
yeah, absolutely. So that's the indicator which I generally tend to follow, because as we know from being in the space for a little while, tech stocks generally do correlate in their movements to what happens in crypto as a whole. So the assurances I've been given this week are, look at the bigger picture beyond just Bitcoin, Ethereum, or your altcoins. So within the crypto space, we've known this for a while. All of the cryptos, generally speaking, tend to have what we call a positive beta correlation, in the fact that if Bitcoin's price goes up or Ethereum's price goes up, the price of all of the assets in the crypto kind of asset class as a whole go up. So with strong beta correlated assets, you tend to have to look at the bigger picture to see what's going on in the wider economy. And what we're seeing is, generally in the last 10 or so years since crypto was born, we've generally seen the rises and falls of crypto's price closely follow what happens in, say, QQQ or S&P 500, which tracks the 500 largest companies in the US. Also, it's worth noting that one of the indicators that I look at is the Dow Jones Industrial Average, the NASDAQ as well as a whole, and they're down about 10 to 30% respectively since the beginning of this year as well. So it's also worth noting and telling people that, look, when money's tight as a whole in crypto space, when money's tight in the economy, money's going to be tight in the crypto space. And what we're seeing, the sell-off recently, is a result of people wanting to cash out of their asset classes, whether it be stocks, shares, or crypto, and trying to get their money into cash. So one of the things that I've also been following recently is the announcement from the Federal Reserve in the US, because we know during the pandemic times of the last 2 or 3 years, there has been a lot of money printing. And when you've got say an economics event such as COVID, when you've got an event that's so kind of, that affects the world so much, such as COVID, and you take really radical actions to print money to keep your economy flowing, that money has to find places to go to. And sure, it's traded between people when they're buying and selling their day-to-day goods. But if you've got an excess of money in a system, which we've generally seen in the last couple of years, especially in the States, it needs to find places to go. And those places which the money went to were assets. So you saw house prices go up, you saw stock prices go up, and you saw the cryptocurrency boom, which was fueled by cheap money. Now the Federal Reserve is announcing the interest rates going up. So that means it wants to claw back some of that money that it released so liberally in the past 2 years. And what does that mean? People are going to have to basically repay back their loans. And the way they're going to do that is sell the assets which have done well for them. So have you made similar observations or have been following the same markets?
Yeah, the exact same. I was going to mention the Federal Reserve last week increased interest rates from 0.25% up to 0.75%, which is the largest interest rate increase for the past 20 years.
That's
And
huge.
yeah, and on top of that, they want to start reducing their balance sheet by $95 billion per month. So as you mentioned, during COVID and the years before COVID, we had a lot of money printing. And the way it effectively works is that the Federal Reserve will buy a variety of bonds and other financial assets like mortgage-backed securities, and they will basically print money to buy these bonds. And it sounds kind of stupid, but you end up with these financial institutions that have sold a lot of bonds and they just have piles of cash and they don't know where to put it, so they just end up buying stocks. And we've had this asset bubble created from quantitative easing, and now we're going into a period of quantitative tightening where the Federal Reserve is going to not renew the bonds that it's previously purchased and stop buying new bonds as well. So you've got this combined effect of interest rates going up and the Federal Reserve ending their money printing, and like you say, asset prices come down. Really, there's less money chasing after assets now. So just the laws of supply and demand means we now have less demand.
Yeah, and it's been a bit of a aggregation of certain events in the last 2 years that have just built up to this stage, right? Not to mention, since the beginning of the year, there's been a war that's been literally declared as well. We're going out of COVID. A number of economies are going into a downward spiral or a deleveraging as well. So some of the European economies are not doing so well at the moment. Certainly in the UK, they had Brexit to deal with, and all of these things kind of on a bigger picture has a knock-on effects, really. But what I mean, just the raise in interest rates, which generally every economy who's been printing money very liberally in the last couple of years, what they should expect at some point is the interest rates to rise, because they've been near zero for so long and there's nowhere left to go, really. Now that the economy is supposed to be opening back up, you have to claw back that money at some point. But in a practical sense, what that means for people day to day is that their loan repayments, say their mortgages or their car loans, they will start to go up in price, their monthly premiums, and businesses won't have as much cash to deploy, meaning that cash will be in a lot shorter supply. So it's going to be harder for them to grow, to hire, to expand. So yeah, certainly preparing yourself financially is going to be the smart move in this current situation. And yeah, I'm just wondering at this point how many conversations you've been having with other people contacting you, asking you what you're doing with your portfolio.
Yeah, I think they're starting to come through really, and yeah, I hope that we can share a lot of good advice on this call. Not financial advice, but a few tips and
Or
insights. But one thing that's on my mind is, do you think it's fair that crypto is correlated to tech stocks? In my mind, I think Bitcoin is more similar to gold than a tech stock. I kind of see the similarities to Ethereum and a tech stock, but I kind of feel like maybe these financial institutions are just uh, unfairly associating crypto with stocks. And if potentially, if they understood it a bit better, they might value it in a different way.
Yeah, certainly the layman's view is to just bunch them up in the same category, really, because it's very easy to do that. The headline sells very well. But in reality, yeah, as you allude to, Bitcoin is seen as the gold standard within the crypto space, or cryptos. For the longest time when crypto existed, let's not forget, it was only Bitcoin. And so the most liquid route into cryptocurrency was to first buy Bitcoin. So the most liquid rails, we call them, to onboard into the crypto space is to use your fiat currency, buy Bitcoin, and then from that, you look for alternative investments. Ethereum is seen as the cryptocurrency of utility. There is practically a computing network, cloud computer attached to this cryptocurrency, and a cryptocurrency represents units of computing power pretty much. And so there is genuine, hugely exciting utility attached to Ethereum. So when people look to diversify within their crypto portfolio from Bitcoin, sure, Bitcoin is the gold of the space. It's the standard, buy and hold a certain allocation within your crypto portfolio. But Ethereum is the really useful use case that everyone from banks and financial institutions, the charitable institutions, are looking to integrate within their businesses to do various different things, from launch and sell NFT artworks, to raise money for different campaigns, to using it as a literal payment rail. That's one day hopefully going to replace what the banks have and use. So yeah, there are absolutely parallels. And yeah, I would actually agree with your statement that it is unfair to kind of compare Bitcoin in itself with tech stocks. But yeah, generally, when I share the correlation between tech as a whole and crypto as a whole, I tend to notice that there is a correlation on a bigger picture. I've not done the analysis as a deep dive, perhaps as you have, but what's your opinion on that?
Yeah, I haven't checked. I have checked the correlation of Bitcoin and tech stocks in the past, and it is correlated over the past 2 or 3 years very closely. And previous to that, it wasn't really correlated. But now, recently, Bitcoin is correlated. And I think that is a confirmation that financial institutions have now entered the crypto game and they are large enough to move markets. And so we are moving at the whim of financial institutions. And they see the wider economic situation unfolding, and they respond by selling everything. So we
Yeah.
go down with them, and I guess we kind of know what's happening. But have you got any ideas on how we should respond? Do you think we should be buying, holding, or selling?
So I mean, on that last point, my thesis is that the reason why I think crypto as a whole correlates with technology is that the people who lend themselves to understanding this technology most of all are firstly techies, right? And when we look at the model of Silicon Valley and all of the Silicon Valley rich people, they're all those who hold. Also, they're also the people and category who are most likely to hold a large proportion of tech stocks, in part because of equity options and how they're distributed to staff, employees, investors, all of which are mostly based in the Valley. And of course, there's a natural segue into these same people using their newfound wealth from technology in crypto. So I think there is, I've personally got a bit of a thesis that the reason why the prices are so correlated is that if somebody's tech stocks go down and they need to dip into the personal slash fund of, to buy that new Tesla, say, for example, they're going to dip into their crypto portfolio, right? These guys out in the valley, they're all one and the same when it comes to tech investments. If they're investing in what they know, what do they know? Well, tech and crypto. So it's a natural segue.
Unfortunately, I do think that during the pandemic years, a lot of people got into investing because they didn't have much else to do, and it was much easier than previous years where you can just download an app and easily start buying different tech stocks. And I don't want to sound like an old guy complaining about how things are more difficult back in their day, but for comparison, I was very interested in investing at a young age, and I started learning about it when I was 17. And on my 18th birthday, I actually opened my first share dealing account. And to open that share dealing account, I had to actually go into a physical bank branch, my local HSBC, sit down with a manager and fill out the paperwork with him to open that account. Whereas now you can just download an app and do it in seconds. So I think potentially people will be hurting, and they will be hurting if they had the mindset where they could just buy during the hype of the COVID bubble and make a quick buck. And in my opinion, to be a good investor, you need to be investing with a 3-year, 5-year time horizon and be investing regularly, not just because it's the latest trend.
Absolutely. So, what I saw the emergence of in the last 2 years are what I like to call armchair experts. So we're all sitting at home during COVID, lockdowns everywhere around the world, no one can go out. And those with relatively stable jobs who could have worked from home started getting bored, right? They've, got an extra 2 hours a day back because they don't have to share that hour with colleagues over lunch. They don't have to commute. And what are they doing? Well, they're looking for ways to spend their newfound disposable income. There's no costs associated with going out and partying with your friends on the weekends. There are no restaurants open at this stage. So not only have they got more money, those that were lucky enough to have stable jobs, but they've got more time as well, and the security of a job, somewhat backed by some of the governments around the world as well financially. And so, yeah, it's just the culmination of events. Add on top of that, the ease of access to a newfound financial system where you can just sign up on an app bank like Revolut, right? And just easily trade assets. And of course, Revolut jumped onto the bandwagon, and where there's demand to look into this stuff and buy this stuff, of course, as a financial institution, they're going to create the products and the ease of use products for people to be able to do that from the click of a button. So yeah, all these events kind of added up to, helping everyone to invest. There was a lot of money in the market. So, and it's a bit of an unfortunate combination of events, really, because when there's so much money in supply and where you can buy almost any asset and see it go up in value, all of a sudden you find everybody becomes an expert. Everybody knows how to make money. Everybody's sharing these stock tips. Everybody's sharing pictures of perhaps it's their Lambos at this stage. There were quite a few Lambo memes going around in the last 2 years, and everybody wants in on the action, right? Who's going to blame them at the end of the day, right? Everybody wants to build a little bit of financial security. And when there's a lot of money around, there's a lot of money to be made. A lot of people, unfortunately, get a little bit too wrapped up in it. They've only just started investing, perhaps it's just their first or second job. They see their portfolio value go up, 10, 15, 20%, whilst comparing it to the interest rate which they're getting in their bank account, 0.5%, 1%, and they think they're almost God's gift to the earth, right? They're like, I'm a savant. I can tell what the market's going to do. I can build my own retirement portfolio. But as you've alluded to, not enough people have had kind of the wisdom of age, perhaps, or that time scale of thinking where, I have to hold this asset for a longer period of time. I tend to always remind myself that there's no such thing as getting rich quick. I prefer the approach of getting rich slow. But on that basis as well, my time frame is much more longer than yours. I try to tell myself, if I'm not willing to hold it for at least 10, 15 years, then it's not worth buying in the first place. And the way I tend to do it is I tend to take a holistic view. What products are there out in the world that I interact with day to day that I'd genuinely like to be a part of in terms of the growth of a company. And it's same for me when I discovered crypto as well. It was a very small space when we joined it. I'm sure you remember. It was a very tiny community. Nobody would back in the day would have, remortgaged their house, especially in the early days, to buy more Bitcoins. But we've heard some stories lately about people doing that, which is a little bit crazy. And it reminds us that there are people out there who forget basic principles on how to manage your own personal risk in terms of your own personal finances and the impacts that could have if you do it wrong as well. Have you seen that lately?
Yeah, no specific examples, but I get the general impression on social media that everyone is shilling tech stocks and the likes of Wall Street bets as well, shilling options, which are,
Yeah.
yeah, it's just not even worth it. I've actually done an options experiment with a small amount of money just to kind of get some experience of it, and yeah, I can verify it's not worth it. So I saved anyone the trouble there. But yeah, where to start? I think the social media trend of just pumping tech stocks has just created a unhealthy bubble and hasn't really increased. I think people have invested in the stock market without learning anything. And me personally, I quite like index funds, and I get paid every month, so I like to buy index funds every month. I like to do something similar with crypto, and on top of that, I will occasionally buy individual stocks as well, just to concentrate a bit more wealth towards high performing companies, which are part of the index fund, but I want a bit more exposure to those because I think they're particularly good. And I guess the reason why I do that is because there isn't one single investment I make that could undo years and years of work. And there's no one single investment that can seriously damage my quality of life. Everything is everything is thought out, very logical, and I'm not diversified to the point of having zero risk and zero returns, but I'm personally trying to strike a balance between concentrating my wealth and not going so crazy that one bad move, one bad mistake can undo a lot of previous gains. And yeah, I think most people have just kind of jumped into tech stocks without really understanding some basic ideas about how to construct a portfolio in crypto and outside of it as well.
Yeah, not just tech stocks. People are going straight into crypto, right? And I'm like, whoa, hang on a second. What have you done outside of crypto? They're hearing buzzwords here and there. The latest buzzword, of course, is Terra Luna, which I heard many times in the last couple of months. For the record, Terra Luna has just taken a big dump as of this week. But yeah, people are hearing about these highly speculative assets and they're wanting to go straight in really heavily, thinking this is my ticket. This is my ticket out of here. Let's YOLO, let's put all our funds in, take a big gamble essentially, and see where it goes. But in reality, the approach isn't spoken about enough of being very conservative. So, the advice I tried to give at that point is let's stop for a second and assess how you're doing in life. If you've been lucky enough to have stable income last couple of years, have you built up a little bit of a cash reserve? Have you built up that 1 month spare cash reserve where if you lose your job, you can survive for a month, no problem, get a new job? If the answer is yes, then great, work on making it 2 or 3 months worth of kind of what we call dry powder, some disposable income where, it's an emergency fund. Stick that in a safe term deposit. In the UK, we have ISA, I think in the US they call it a CD, which is like a depository account, which is meant to protect your income, and then just have that as your safety buffer. You know, if you're disciplined enough to save more than that, then great. Start looking at assets, investments. The big difference between those who end up, you know, managing a little bit of wealth and those who are poorer is just the lessons in knowing that it's very valuable to hold on to assets, because if you hold on to, say, for example, some Apple stocks, let's not forget there are loads of clever people all around the world working for this company, trying to make that company more valuable, trying to sell better products to people. And it's very easy and accessible these days to be able to get access to buy a stock like that. And so, you know, if you're, so going back to the practical advice, if you've got your emergency fund of a couple of months' salary, yeah, consider then diversifying into different stocks or shares. So your approach is great. Index funds, they generally track the performance of the market, and index funds generally tend to outperform your savings accounts as well. And if you, let's not forget here, you know, some people are a little bit scared about doing this, but then they prefer to do it within a pension fund at their company. But, you know, having worked a little bit in finance, I can definitely allude to the fact that these people in pension funds aren't necessarily knowledgeable about what they do. And if you can be more disciplined yourself about parking some money in assets and not touching it for many, many years, then you're going to outperform a pension fund in the long term, who's going to take that 0.5% fee every year, which adds up to being a lot of money, which people are not aware about. So yeah, the approach of accruing assets, accruing, say, an index fund is great. And then once they understand that the risks that they're taking in their own financial portfolio are manageable, are controlled, then and only then should you really look into cryptocurrency, which I assure people only belongs in a high risk asset category.
Yeah, those are really good points. And I think something that is not said enough is the key to success in crypto is to have your non-crypto finances in order. And I can really speak from example because I'm really lucky to have got into Bitcoin pretty early. Like I started learning about it in 2013 and then I was fully into it in 2014. But the timing was really bad for me because that was during my final year of university. And in my first year out of university, I was starting my own business as well. So I was so cash poor. I'd never been so cash poor in all my life. And it was, you know, firstly difficult to find money to put into crypto, and it's much harder to hold on. So when you are financially secure, you're able to put a small amount into crypto and kind of forget about it. Whereas if you have money in crypto and that money means a lot more to you, you're going to panic a lot more easily when the prices drop. And when the prices rise, you're much more likely to sell. I do think that people shouldn't be punished for taking profits, but at the same time, to unlock the maximum potential from crypto, you do need to have good overall financial health. And a good example that might illustrate this is if you imagine a single mother, she could buy $100 worth of Bitcoin, and that could be so much money to her that it's risky. It could even pay off, and the price could double, and now she has $200. The reality is that she's very likely to sell because it's a great return. She's doubled her money, and I'm sure that $200 could buy so many things in her household to make a big difference to her life, which is really good result. But 10 years later, that could be worth, say, $50,000, right? And in order to have that ability to hold on for a very long time, you really do need to have good income coming in, you're spending lower than your income, and you have an emergency fund, like you said, and you've got regular investments into crypto and elsewhere. So if you're generally overall in a good financial position, you just have a lot of margin of safety to invest in crypto And that also really helps reduce the temptation to sell early or sell early at a loss or even for a small profit.
Yeah. I find a really important lesson to teach people is to assure them that investment is nothing but relatively straightforward maths, right? If something goes up, it's an addition. If something goes down, it's a subtraction. However, what we're taught from our families growing up, what we're taught when we enter the working world, what we teach ourselves when we earn our first bit of income is money's a very emotional thing. People get so wrapped up in the excitement of being able to have some disposable income to spend. People are so fearful at losing as well. If they've not got much as well, it really, each $100 really can, in a scenario of the single mother, impact the quality of life quite significantly, right? So there's no getting away from the fact that how comfortable you feel emotionally is going to be attached to money. The more you can try to detach that and try to approach it from a logical sense perspective, the better it will help you in the long term, and the better it will teach you a little bit more financial discipline, which in reality, me and you can discuss to no end, but we both know and have experienced the fact that financial discipline quite often in reality means mental discipline. How are you able to keep your emotions in check? So yeah, the message to those out there at the minute is if you're feeling a little bit of pain, don't worry. It's the markets are playing out their natural cycles. Sometimes they're referred to as fear and greed cycles, where the market over leverages, pumps up, and the market contracts as well. Every economic cycle tends to repeat this image in the wider financial markets. It tends to repeat itself. They say every 7 to 12 years, you can expect a recession to happen. And every time a recession happens, everybody acts very surprised. But in reality, this has been happening for, at this point, perhaps even 100 years. You can look at the charts online, give it a quick Google if you wish to educate yourself more. But yeah, certainly do expect these times to happen. Do try to protect yourself financially by kind of assessing how much risk you're taking and what that risk means to you as well. And try to position yourself such that you're isolated from these risks, that your day-to-day expenses can be taken care of, even if the market is going down for a couple of years.
Yeah, I like the advice on thinking logically. And just to tell a quick story. So when I was into crypto in 2014, I didn't have tons of money, nowhere. My salary was nothing compared to today back then, and I would still invest what I could afford. The 2017 bubble comes along. I genuinely needed that money, so sold out pretty much everything. I actually got really, really lucky. Just I managed to time the top by a complete fluke. I saw the price go up to 10K, and I thought, yeah, I really need to sell. I was busy, and then a week later it was like 20K, and I thought, okay, busy is not an excuse anymore. You need to sell. That was just luck. But then I was without any crypto between say 2018 and early 2020, unexpectedly I got back into it at 10K and held everything to present day, and I still buy Bitcoin, and I think that surprises some people because back in the early days I could buy Bitcoin for $200, and now I need to spend $30,000 if I just want to buy one. And it sounds a bit counterintuitive, why would you possibly be buying something so expensive when it used to be so cheap? And I just remain stoic and think to myself that I have this fiat money coming in every month and it needs to be allocated somewhere. And I personally do believe that crypto will outperform my index funds, and it makes sense to allocate a proportion of my income to crypto. It doesn't matter that it's more expensive than what it once was. I just think the returns are going to be, I personally think the returns are going to be higher than my index funds. So why would I not still be buying?
Yeah, price is a relative thing as well. As with all assets, even if the price is 30,000 today, if it's 30,000 and $1 tomorrow, well, today's price is actually cheap. And that's happened in so many days of our kind of crypto startup careers. And so many people have said to us, at every point of the way, from $100 to $1,000 to $10,000, all the way up to current day. Every day there's someone out there saying price is really expensive, but if it's not understanding that if it's more expensive tomorrow, then today's price is, relatively speaking, cheap. And just the way that the world works and the economies are structured, it's worth noting that money is generally supplied at a rate of inflation of about 2% a year every year. So by virtue of the mathematics, especially if you kind of zone into the US markets, you would expect companies that are growing to always be setting record highs. And so if you zoom out on the bigger picture of many of the largest companies, you can generally see that pattern. Companies tend to die off because people stop using or consuming their products, but with the companies providing products that are perpetually used, if you look at their stock price charts, you can see they're only going in one direction, really, growing.
Yeah, I think a lot of people, well, 20% of people in the UK invest in stocks, and I suspect of that 80% who don't, they're pretty much fully in cash. And I think the general perception is that stock prices just go up and down. That's what like the uneducated masses believe. They just believe stock prices go up and down. And
so this is the mind-blowing fact, actually. So 20% admit to owning stocks. The other 80% also own stocks, but don't know they own stocks because they have a pension. And what does a pension do? Invest in stocks. You'll be surprised and shocked at how many people don't realize that, oh no, I don't dabble with the stock market, it's far too risky. But hang on a second, you're putting all of your money in a pension fund, which very rarely outperforms the general market, right? So and when I talk to these people, I do feel a little bit of pain for these people, because I wish they understood more about how the system they're engaging with works, actually, and how the system they're engaging with, the pension system, is sometimes rigged unknowingly against their best interests, which is a little bit sad, which perhaps is a good segue into the crypto portion of the discussion, really. What crypto stands for is that people have more kind of control or autonomy over their own personal finances, whereas we've been encouraged through this legacy system that the best thing to do is supposedly use your company, look for a pension scheme to invest in, and trust a so-called expert with all of your money. And sure, there are controls in place to put some limited protections for these fund managers to protect your investment. But in reality, all these people along the way are salaries that need to be paid, and there's salaries that ultimately come out from the amount that you're depositing into the pension scheme. So it's almost like a tax in a way that you've agreed to, that you also don't necessarily agree to, which ends up costing you in the future. But a lot of people who are less educated only find this out when it's a little bit too late, when they're 65 or 70 or nearing their retirement age, when they could have been, in reality, taking advantage of the compounding effects that investing starting from your 20s has. We're talking 50 odd years worth of compounding gains here, versus being charged that 0.5% pension management fee every year for 50 years.
Yeah, when you look back, you see the growth. And I was just going to say, the perception is that stocks, and I think crypto as well, the perception is that it just goes up and down. What people don't see until they look back over a 20-year horizon is they do go just up and down, but they do gravitate more up than down. So up and down, but more up than down. So people, with a short-term investment horizon and without doing proper homework, don't really see the underlying growth. And yeah, I think what we're seeing right now in crypto and the financial markets is the down. I'm sure, every financial crash ever has been followed with a upside, and I'm sure that upside will continue for a bit longer than the downside, and then will be another downside, and then the upside will continue for a bit longer than that downside, And that's how you get your long-term compounding growth with setbacks along the way. Really, it's just the natural business cycle, really.
Yeah, it's an economic cycle, and one that's very well documented in economics textbooks. What people love to talk about is, the short-term pain, but what people don't like to talk about is what's the lesson that we can learn from these situations. So I noticed you alluding to the fact that you dollar cost average. Perhaps that's worth talking about, or perhaps it's worth zooming straight into the crypto portion of what people should do, given what we do at DefiDive. So what do you say?
Yeah, I have some good charts to share, and I will I will weave in dollar cost averaging into this as well. And what I want to share is a long-term trajectory of Bitcoin. And what we're looking at here is the price of Bitcoin since 2012 on a log scale with weekly candlesticks. And as we we're just talking about, crypto Bitcoin goes up and down, but the general direction quite clearly is upwards. And I personally buy every month, so it doesn't matter whether the price is up or if it's down. But nonetheless, what I want to call out is this moving average here. And we're going to go on a bit of a journey to understand where Bitcoin is currently valued at. The moving average I quite like to use for bear markets is the 100-week moving average. And this is just a reference point to show how expensive or cheap Bitcoin is compared to previous prices. And we can see historically when the price has fallen below the 100-week moving average, it has been a particularly good time to buy. You can say that any time in the past has been a good time to buy Bitcoin if you held on long enough. But in these areas here is particularly good times to buy. And this is where the price of Bitcoin is cheaper than the 100-week moving average. So right now, the 100-week moving average is 36K. That means over roughly the past 2 years, the price of Bitcoin has been 36K. And we've recently crossed over to 30K right now, 32K to be more precise. And again, I'm personally looking at this and I'm seeing that Bitcoin relative to other time periods is considerably good value for money. So, I'm personally tempted to buy a bit more than usual. I think there's a good conversation to have in a minute about waiting for the absolute bottom or just buying when you see value. But at the moment, I see value. And I think the next question people will be asking themselves is, okay, Bitcoin has dropped. Potentially it's good value to buy, but how far could it drop? And I think the best educated answer we could give to that in a concise way is the 200-week moving average. And historically, when Bitcoin has entered bear markets, the price has crashed to the 200-week moving average. You can see that in 2015, again in the 2019 bear market. The COVID crash did go a bit below it, but we did actually close the weeks pretty close to that moving average. And I like moving averages because they are a moving target. So with this bull market, the price didn't go up as much as compared to the previous bull market. So the logic is we don't need to come all the way back down. If we were having a bear market that was as strong as the previous bear market, we would already be at 18K and we'd actually finish the bear market at 9K. Me personally, I don't think we will be going down to 18K and 9K. That would undo all of the gains from this bull market and we'd be settling down to these levels. What I think is more likely is if someone did want to time the bottom, they should be watching this 200-week moving average. And right now it's at 22K. By the time we can realistically get there, we can kind of roughly eyeball that the price could hit it, say in July, and that would be at 25K. So that's what I'm watching. And me personally, I will be buying Bitcoin regularly, just like I do. But if I do have some spare cash, I see this as a good value time to buy personally. There is a chance that we see this pattern where it's good value, and we think we're seeing the same pattern here where we think it's good value, and something disastrous could happen, and we can be completely wrong. But based upon the information I have, what I'm seeing on the chart, I personally interpret this as good value for money. And there's a couple more things we can layer on to keep telling this narrative. So the next moving average I've added is the 20-week moving average. And this is interesting because when the 20-week moving average has crossed over the 100-week moving average, that's been really close to the bottom. So when that happened in 2014, the market bottom was a couple of weeks afterwards. And then in 2018, we had the crossover, and that was the exact week of the market bottom. And what's really interesting that I'm watching personally is we are also going to have that crossover. You can see how the purple line is trending downwards, the blue line trending upwards. It's not going to happen this week, but I expect in June they are probably going to cross over. So the lesson that is telling me is we're pretty close to the bottom, but not quite there yet. And if I was to guess when the bottom is going to happen, based upon what I'm seeing, I think we'll probably bottom out within the next month. We can keep this going with an extra insight. And these all tell the same story, by the way, of it appears that Bitcoin is good value for money, but it also appears there's room to fall further. The extra insight I want to share is the weekly RSI. So this is very similar to a moving average, but it also considers momentum. I don't know the exact formula behind it, but what we really need to know is that when it's at 70, it means Bitcoin is expensive. When it's at 30, it means Bitcoin is cheap. And what's really interesting with this is on the weekly basis, the RSI has only ever gone to 30 at the absolute bottom of this bear market and this bear market. It has never ever gone that cheap except for the absolute market bottoms. And as you can see in present day, we're at 35. So we've got scope to fall a bit further down to 30. And I'll be watching that. I will see that as a bottom indicator if that does happen. But nonetheless, what it's telling me is that the price of Bitcoin is cheap. If we look at when was the last time the weekly as RSI was at 35, you can follow my line down here. The last time was the COVID crash, deep 2018 bear market, deep 2014 bear market. So, I'm not giving financial advice, but I see value on the charts, and I'm just a messenger relaying what the charts are saying.
Yeah, no, it's thanks for sharing. I think it's worth sharing that technical analysis, which is what you're doing here, is one way to essentially remove emotion from the equation, right? The other way you've alluded to is, and a more simpler way that I tend to recommend people is just dollar cost average, which basically means just have a certain allocation of your salary. Say you can spare $100 every month. Put that into Bitcoin or Ethereum or whatever the asset's going to be, stocks, index funds, every single month on the same day every month, which removes the need for you to look at charts altogether. So what we're doing with technical analysis is we're trying to use the historical data to see if we can draw some correlations. And certainly what you shared there about moving averages, I do know within technical analysis and chart reading, that is the most popular indicator, which a lot of markets do follow actually. So yeah, I think it's really, really valuable for people to kind of learn about these different tools, try to figure out what's right for them, and try to gauge how much risk is worth them taking. But I will caveat that with one piece of additional advice. If you ever come across anybody who proclaims to be able to use whatever tools to predict what the price is going to be tomorrow, they're not worth listening to. So use these tools to kind of give yourself indicators, but don't think that they can predict the future any better than the next person.
Yeah, a lesson that I learned in the early Bitcoin days is that there were quite a few long-term models on predicting where the price of Bitcoin was going. And the bear market was twice as long and twice as deep as any of those markets predicted. And, things still worked out okay for Bitcoin. And I think particularly models like, say, the stock to flow model, we see models that are correct for a period of time, and then when they are invalidated, people just simply forget about them and move on to the next model. And with any one model, any one piece of analysis, you cannot put too much faith into it. And going back to the technical analysis I just shared, I think you can't place your entire investment strategy into the hands of those moving averages. What I use those moving averages for is to make a educated guess, and I'm very well aware that things can go wrong. Things can go disastrously wrong, or the timing can be slightly incorrect. And in so many ways, just buying Bitcoin regularly is the best way to insulate yourself from really bad mistimings. And what I would also like to say is that I think too many people are worried about timing the market. And I've got a very good story to share on this. And this was during the COVID crash, where all the stock prices dropped, all the crypto prices dropped. And my approach during the COVID crash was to keep buying my index funds. And I was buying them more regularly and higher amounts than usual. Not saying this will work again, but this is what I did. And I was buying my index funds on the way down. I bought at the bottom. I didn't know it was at the bottom at the time. It was just heading down. I'm just still buying. And then as the price was going up, I kept on buying. And when I was buying as prices were falling, I had a conversation with a friend of mine. He's very smart, but he doesn't know much about investing. And he genuinely thought I was an idiot for buying my index funds, even when I believed that the price was going to go lower. And he said, "Why would you buy when you believe the price is going to go lower?" My reply to that is, I don't believe I can perfectly time the market. His approach was to wait for the bottom, and he was going to buy at the bottom. I was buying on the way down, I bought at the bottom, and I bought on the way up. What he did was kept on waiting for the bottom. When we hit the bottom, he didn't realize we had hit the bottom. The price started to go up. He thought, I might as well wait for the price to go down again. The price didn't go down. The price kept on going up. And then he decided, I'm not going to buy because I've missed my chance. And he never bought at all. And so, the lesson from that is, I show that the price has historically bottomed out at the 200-week moving average, but I don't believe you should try to perfectly time it and wait for the price to hit that 200-week moving average. There's a lot of Bitcoin traders who are watching that 200-week moving average, and they will be buying as we approach to it. And that could even mean we never fully hit the 200-week moving average. Yeah. We could also just blow right past it. So, you can only really make educated guesses. And I guess if you just make one trade a year, there's a very good chance that trade is wrong. Whereas if you can make, say, 12 trades a year, once per month, or 52 trades per year, once per week, then you really do reduce your risk of that one trade being bad. And you're giving yourself more shots to hit a bullseye.
Yeah, the idea is you're not beholden to a single price or trying to time that perfect second in the entire year. So your friend went with the model of try and predict the future. You just went with just by the price average, which I think is a really, really sensible approach. But I'd like to share a bit more about my approach, actually, because I used to follow some chart reading. I think it's a great tool to learn as well. And it's great to know that there are a lot of traders out there following these chart movements, because you do see correlations from time to time, and you say to yourself, wow, this crossover perhaps was because so many traders are watching for that crossover movement, that they've kind of emphasized that movement by trading at that moment, which we definitely observed during our time when we were operating a trading platform, right? But I'd like to share my after kind of a couple of years experience, I've kind of taken a step back, and I'm always asking myself now, what's the bigger picture? And I like to take a more classical, okay, let's put our business hat on and see what's going on in the wider world kind of stance. So when it comes to Bitcoin, at this point in 2022, if I was to sit down, discuss it as we are now, I'd say to you, look, let's look at the history of what's happened with Bitcoin when we first got involved 10 or so years ago. The market and the number of people involved in the space were relatively small, right? We could go to an event, a Bitcoin event, because it was only Bitcoin back then, and there'd be less than 10 people there. Probably the amount of people in the world involved at that point were probably in the thousands. So they were pretty hard to come by. And if we kind of fast forward to 2022, we see the adoption of cryptocurrency hit mainstream and more during the start of the pandemic, right? So what does that mean from, a quantified metrics perspective? It means that there are more Bitcoin addresses out there distributed to more people. And it means that Bitcoin is concentrated, is not as concentrated because it's in the hands of more people, more institutions, more companies, more individuals. And there's a metric that economists like to talk about, which is monetary velocity, which is how much a certain amount of Bitcoin gets sent onwards and how much gets stored in each individual wallet. Long story short, not to overcomplicate things, is what we're seeing in 2022 is a much wider distribution of Bitcoin in many, many more wallets, meaning many more people hold the asset. And with that becomes, the network effect is compounding upon itself, really, which is creating more stability, a stable base in an asset. And because more people are owning it, more people are discovering the benefits of holding Bitcoin, what the technology actually was invented for, what it does, and what it stands for as well. So what we're finding in this day and age is, there are a lot more advocates for crypto, for something like Bitcoin to work, actually. And there are a lot of people out there that are using Bitcoin as an alternative hedge against their current assets. We saw that was a great hedge against inflation when money printing went crazy. And we still see today that it's quite protected against certain industries. And so, overall, with that lens applied to it, we're seeing stories of companies like Twitter, like Tesla, like MicroStrategy holding more and more Bitcoin on their balance sheets. We understand in this day and age, a lot of banks and financial institutions, hedge funds, family offices are also parking a proportion of their wealth in Bitcoin as well. So again, taking the macroeconomic, zoomed out picture of the view of the world, especially with your business hat on, we've got a lot more people with a lot more what we call vested interest in Bitcoin sustaining its current price, if not growing. So whilst neither of us can predict what's going to happen from one minute to the next, we do know from a practical sense that there are a lot more people behind crypto in 2022 than 10 years ago. So that for me is a really positive economic indicator, some of which can be quantified, some of which is somewhat common sense. So yeah, I mean, if you do this kind of research, you'll see all of these routes pointing towards these very bullish signals, I'd say.
Yeah, you're basically describing the other side of the same coin. So on one side, you've got the price and averages and trajectories, and then on the other hand, you've got fundamentals. And I have also been looking at the fundamentals of Bitcoin as well, right? And I don't look at the metrics like the network hash rate, the number of wallets. Those are all, I presume, going up last time I checked, and it's further validation. But one analysis I have done is benchmarking Bitcoin against gold, and Fidelity has benchmarked Bitcoin against gold and fiat, where they rank each of these assets as a store of value, how fungible they are, how divisible they are, how easy it is to transport, the storage cost, the environmental credentials, and they basically give them, a plus, or a cross to see how they compare against each other. And their study shows that on most attributes, gold is a better store of value. So on most attributes, they show that Bitcoin is a better store of value than gold, according to Fidelity's own research. So let's take a conservative view and let's believe I think Bitcoin is at least half a good of a store of value of gold. What you need to start with to do this benchmark is you take gold's market cap. It's about 10 trillion. And of that 10 trillion, that's based upon the number of the amount of gold ever mined. And it's 50% of gold that is mined is used for investment. And if you break down the numbers, if you believe Bitcoin is half as good as gold as a store of value, it equates to 170k per Bitcoin. That should be the price of Bitcoin if you believe it is at least half a good of a store of value compared to gold. So I often think to myself, I don't care what the price is. If it's below 170k, 150k, in my eyes, it's cheap. So I'm buying. Not financial advice, but if I benchmark it against gold, that the numbers just simply come out that Bitcoin should be worth 150k at a minimum, 170k based on more recent uptrends in the price of gold. And yeah, I don't need to overthink it really. If Bitcoin is below that price, I think it's a good time to keep buying every month. And if Bitcoin reaches above that price, I might have to reconsider my calculations and see whether I should be benchmarking Bitcoin against gold or other numbers really to try and work out what's fair value.
Yeah, I'm just looking at the statistics now, actually, and the market cap of Bitcoin currently stands at 600 billion, I believe. And the market cap of cryptocurrency as a whole sits at about 1.4 trillion. Just to give you a sense of scale, and you were saying the market cap of gold is?
From my last memory, it's about 10 trillion. That was a few months ago, so the prices could have moved. And that 10 trillion is based upon the amount of gold ever mined. So for some facts, 44% of gold is used in jewelry, 6% of gold is used in making things, and 50% of gold is just used as an investment. So I have actually done the exact math, so I just don't have it in front of me. But if you look at that 50% gold market cap and you think Bitcoin is at least half as good as gold as a store of value, then the numbers work out to be between 150k and 170k per Bitcoin. So yeah, the price can do whatever it likes. I'm waiting for 170k.
That's good to know. So yeah, what you've alluded to is that the central banks around the world are huddling onto their gold bars, trying to shill gold as much as possible, whilst the real people out there trading away are using Bitcoin as a modern store of value. Yeah, its market cap at the minute of just as cryptocurrency space as a whole is 1.4 trillion is quickly approaching that of gold, and I do believe within our lifetimes we might see the market cap of cryptocurrency overtake gold, just purely on the fact that there is actually a more genuine utility in the cryptocurrency space in this day and age than there is gold has utility in terms of material. So yeah, beyond jewelry as a good use case, beyond gold used within industry for its scientific properties, I believe it's a good heat shield or heat insulator. Beyond that, there really isn't much that central banks can do when they lock up gold bars in their vaults. People are quickly realizing that, and in reality, the governments have been fairly open about this. Not many people appreciate this image of the world, or this picture of the world, or the history of finance, where the government announced a departure from the gold standards many years ago in the US, and the rest of the governments out there followed suit. So for a long time, whatever the government has been saying, their actions have been very telling that the governments around the world no longer believe in gold as a store of value as much as they do their own fiat-backed paper currency, which they print a lot of on tap. until of course Bitcoin's use case comes to comes to light in the recent years. And so yeah, what we're seeing is more and more traction and belief that Bitcoin is a very legitimate store of value. And it's a very exciting future. And we've not even started speaking about Ethereum or the altcoins or the use cases that we're seeing all the really, really smart developers work on at the minute in the space. It's crazy what's going on. So perhaps that's time for more podcasts. We've barely even covered, NFTs, DeFi, what our company's named after. There's new trends in our market now called FitFi, fitness finance. It's hugely exciting. And yeah, I can't wait to see where the future brings us, really.
Yeah, we'll wrap things up because there's just so much we need to talk about that we'll have to do future episodes. And where do you see crypto, Bitcoin, and Ethereum heading for the rest of this year? And what's your long-term outlook?
So my long-term outlook, of course, with my 5 to 10 year outlook is, of course, just incredibly bullish. What's going to happen this year? I'm going to give a conservative answer and say, it's very difficult to know what's going to go on with the political stance in the world at the minute with wars being declared. I certainly do think that money supply is going to tighten throughout the course of the year because there's been so much money printing going on lately. I do think that's going to adversely affect cryptocurrency prices in the short term. In the long term, I just see pure growth. So I guess my advice to anyone else out there listening is to just be careful throughout the rest of the year, be conservative, don't take too much risk, and understand that cryptocurrency and Bitcoin as a whole is a risky asset class. If you got those kind of lessons learned under your belt, then you'll be in a good position to kind of benefit from the current price dip. So use your disposable income to invest in crypto would be my advice, but make sure that the rest of your finances are in order first.
Yeah, it's really good advice. Not financial advice, but I like the insight. And yeah, I think my closing thoughts really are just to have a long-term view. I discussed earlier that we appear to be in a good value territory for buying Bitcoin, but we have previously spent 1 year in this good value territory. So there's no need to rush in. Likewise, there's no need to try and perfectly time the bottom, but just think about what assets you want to hold for the next 10 to 15 years and steadily accumulate them. And if you believe they'll do well in the next 10 to 15 years, then you should be quite happy to accumulate at a lower price than you would without this crash.